Alright folks, welcome back to Boss Economics World, the only show on the internet that treats the global economy with the appropriate level of panic and dark humor it so richly deserves. Today, September 13th, 2025, we are standing on the precipice of what the financial wizards and well-paid spin doctors are calling a dovish pivot. That's a lovely, sanitized term, isn't it? It sounds like a graceful ballet move. But let me translate it from Wall Street jargon into plain English. The Federal Reserve, the high temple of American monetary policy, is about to hit the panic button. A new Bloomberg survey of our finest economic minds, the same folks who brought you hits like transitory inflation and a soft landing is guaranteed, is now screaming in unison, rate cuts are coming. Not maybe, not someday, but next week. And not just one. The median forecast is for 2 cuts by Christmas, with a rowdy 40% of the crowd chanting for a triple play of monetary easing. The futures market, that hyperactive casino of global capital, is already pricing in 3 cuts as a done deal. So, the big question is, why? Why the sudden, screeching U-turn from the inflation-fighting crusaders who spent 2022 and 2023 hiking rates like their careers depended on it? The official story, the one you'll hear from Chairman Powell at his press conference next week, is all about the cracks in the job market. And that's our starting point today. We're going to peel back the layers of this economic onion, from the surface-level data to the stinking, rotten core of political pressure and institutional decay that lies beneath. Buckle up. For months, the FOMC clung to the word solid to describe the labor market. It was their security blanket. While the rest of the economy was showing signs of strain from the most aggressive tightening cycle since Paul Volcker was a household name, they could always point to the jobs report and say, see? Everything is fine. Well, folks, that solid foundation has just been revealed to be made of plywood and wishful thinking. The headline number that's spooking the Eccles building is the unemployment rate ticking up to 4.3% in August. Now, in a historical context, 4.3% doesn't sound like a catastrophe. But economists don't look at the number, they look at the delta. The trend. And the trend is, as the kids say, not our friend. This is the highest we've seen in nearly 3 years, a clear signal that the lagged effects of those rate hikes are finally sinking their teeth into the real economy. But the headline is just the trailer. The real horror movie is in the details, specifically, the revisions. The Bureau of Labor Statistics recently revised its earlier job growth numbers, and it was a bloodbath. Average monthly job growth in the year through March 2025 wasn't the robust 250,000 we were told. Oh no. It was revised down by roughly half. Let that sink in. For a year, the Fed was making policy based on data that was 100% wrong. This isn't a rounding error, it's the statistical equivalent of navigating by looking at a map of a different continent. It speaks to a deeper, more troubling issue. Our traditional economic indicators are struggling to capture the weird, fragmented nature of the post-pandemic, post-AI boom economy. What kind of jobs are we even talking about? The data from late 2024 and early 2025 showed a disturbing trend that's now accelerating, a surge in part-time employment for economic reasons. This is the category for people who want a full-time job but can only find part-time gigs. It's the shadow unemployment rate. Furthermore, the divergence between the establishment survey and the household survey has become a chasm. While big corporations were still hiring, the small business engine of America has been sputtering, choked by high borrowing costs. Remember the Great Resignation of 2022? That was a sign of a vibrant, confident workforce. This is the Great Capitulation. Workers aren't quitting for better jobs, they're getting laid off from their tech and finance gigs and are now delivering your groceries, hoping to string together enough hours to make rent. This is the reality behind the cracks, and it's why Powell, in his Jackson Hole speech, started talking about a shifting balance of risks. We were so obsessed with fighting the last war, inflation, that we might have just sleepwalked into the next one, a recession. This brings us to the Fed's core dilemma, its schizophrenic dual mandate handed down by Congress, price stability and maximum employment. For decades, these two goals often worked in tandem. But today, they are in open conflict. It's like being told to win a hot dog eating contest while simultaneously training for a marathon. You simply cannot do both at the same time. Let's rewind. In 2022, inflation peaked at over 9%, a 40-year high. The Fed, led by a chastened Jerome Powell who had to retire the word transitory from his vocabulary, went full Volcker. They jacked up the federal funds rate from near zero to over 4.5% in a historic sprint. Their goal was to destroy demand, cool the economy, and break the back of inflation. And to a large extent, it worked. The consumer price index has fallen dramatically. As of our latest reading, core PCE, the Fed's preferred metric, is hovering around a stubborn but manageable 3.2%. It's not the Fed's 2% target, but it's a hell of a lot better than 9%. The dragon has been wounded, if not slain. But the medicine has side effects. And the primary side effect is a slowing economy and a weakening job market. This is exactly what economic theory predicts. You can't make borrowing more expensive for every business and every consumer in the country and not expect something to break. So now, Powell is on a tightrope. Lean too far one way, and you risk pushing millions of Americans out of work and triggering a deep recession. Lean too far the other way, and you risk the 3.2% inflation reigniting and roaring back to life, undoing all the painful work of the last 2 years. This is the shifting balance of risks he mentioned. The risk of a 1970s-style inflationary spiral has diminished. The risk of a 2008-style employment collapse has grown. The survey shows a deeply fractured FOMC, a committee at war with itself. You have the superdoves like Governors Bowman and Waller, who, in a stunning reversal from their previously hawkish stances, are now apparently so terrified of a downturn they are rumored to be pushing for a 50 basis point shock and awe cut. They see the employment cracks and want to flood the system with cheap money now. On the other side, you have the lone hawk, Kansas City Fed President Jeff Schmidt, who will likely dissent in favor of holding steady. He's looking at that 3.2% inflation and thinking, our job isn't done yet. A premature celebration could be fatal. And in the middle, you have Chairman Powell, trying to engineer a 25 basis point cut that will be seen as too little by the doves and too much by the hawks. It's a compromise designed to please no one, a perfect metaphor for the impossible position the Fed now finds itself in. But wait. Is this really just about the dual mandate? Is this a purely technocratic debate about economic models and data revisions? Or is there a giant, orange-hued elephant in the room? Let's be blunt. The Federal Reserve does not operate in a vacuum. It operates in Washington, D.C., and in 2025, that is a very dangerous neighborhood. The survey reveals the heart of the matter. 71% of economists are somewhat or extremely worried that monetary policy will become influenced by political loyalties. This isn't some fringe conspiracy theory, this is the consensus view of the professionals who watch this institution for a living. President Donald Trump, in a move that surprises absolutely no one, has been waging a public war against the Federal. He is demanding rate cuts of up to 3 percentage points. This isn't a policy suggestion, it's a toddler demanding more ice cream. It has no basis in economic reality. A 300 basis point cut with inflation still north of 3% would be like throwing gasoline on a fire. It would trigger an inflationary catastrophe, destroy the dollar's credibility, and make the 1970s look like a golden age of stability. But it would also goose the stock market and juice the economy just in time for an election cycle. And that's the entire point. This isn't just rhetoric. It's a direct assault on the institution itself. We have the unprecedented situation of the president attempting to fire a sitting Fed governor, Lisa Cook. While the courts have so far kept her in her post, the message is clear: toe the line, or you will be targeted. This is a tactic straight from the playbook of failing states and banana republics, where the central bank is nothing more than the president's personal printing press. Why is Fed independence so sacred? Because history has taught us, time and again, what happens when it's compromised. Look at Turkey under Erdogan, or Argentina for the last several decades. When politicians get their hands on the monetary levers, they will always choose short-term electoral gain over long-term economic stability. They will print money to fund their projects and juice the economy before an election, and the public will pay the price through the hidden tax of hyperinflation. The scary part is how financial markets are reacting, or rather, not reacting. The 10-year Treasury yield has been falling, and market-based inflation expectations are steady. The traditional alarm bells aren't ringing. Why? Slightly more than half the economists in the survey hit the nail on the head: investors are underestimating the political threat. They see the political noise as just that, noise. They see a weakening economy and think, of course the Fed will cut, that's their job. They are pricing in the what but completely ignoring the why. They believe the Fed is still an independent actor making a data-driven decision. This is a monumental miscalculation. As Professor Tom Fullerton of UT El Paso warned in the survey, this combination of political pressure to ease while inflation is still a threat is coming perilously close to unleashing stagflation, the toxic 1970s brew of high inflation and stagnant growth. And that brings us to the core of the onion, the stinking, rotten center of this whole affair, a profound crisis of credibility. For a central bank, credibility is everything. It's the only real currency it has. The belief that the Fed will do what it says it will do, that it will fight inflation no matter the political cost, is what anchors inflation expectations. If that anchor is lifted, we are lost at sea. This upcoming rate cut, regardless of its economic justification, will be perceived by many as the Fed caving to political pressure. It doesn't matter what Jerome Powell says in his press conference. It doesn't matter how many charts he shows about the labor market. The context is undeniable. The president demanded massive rate cuts, and now the Fed is cutting rates. The optics are a disaster. This creates a vicious cycle. If the Fed is seen as politically compromised, its future actions will have less impact. If they try to talk tough on inflation, no one will believe them. They will have to slam on the brakes even harder in the future to get the same effect, causing even more economic pain. They have spent 2 years painstakingly rebuilding the credibility they lost during the transitory inflation fiasco. They are about to set that rebuilt credibility on fire. So, what does this mean for you? For the average person, it's a world of confusion. The rate cut might lower your credit card interest or make a mortgage slightly cheaper in the short term. But the reason for the cut, a weakening job market, means your job security is lower. And if the Fed is seen as weak, the inflation that has been eating away at your paycheck for years could come roaring back. You're being offered a small treat today in exchange for a much larger stomachache tomorrow. For the finance professionals, this is a treacherous environment. You have to game out not just the economy, but the political circus. You have to ask, is the Fed acting based on its models, or is it trying to appease the White House? Will Powell stand his ground, or will he fold? The disconnect between the sanguine bond market and the terrified economists is the arbitrage opportunity of a lifetime or a widowmaker trade. We are watching a slow-motion car crash. It's a collision between a weakening economy, a stubborn inflation problem, and a political class that sees the Federal Reserve not as a vital, independent steward of the economy, but as just another lever to be pulled for political gain. The decision next week will be more than just a 25 basis point adjustment. It will be a signal. It will tell us whether the Federal Reserve of 2025 is the institution of Paul Volcker, willing to endure immense political heat to do what is necessary, or if it has become a hollowed-out shell, conducting monetary policy by tweet. So, as we await the white smoke from the FOMC conclave, remember what you're watching. It isn't just economics. It's a battle for the soul of one of our most important institutions. And right now, it looks like the soul is losing. That's all the time we have. Stay cynical out there. I'll see you next time on Boss Economics World.